What about you, John?
I think that the credit agencies contributed to the crisis. Why do I say that? I say that because they came too little and too late to give us warnings, either about corporate debt or sovereign debt. And there is an ethical, moral issue there. When in the 1950s, for example, Standard & Poor's or Moody's were established, the investor was paying the fee to the credit agency and say, look, I want to buy XYZ. Could you please let me know whether it's a good buy? Nowadays, it's the banks or those who issue the paper, the debt, that pays the fees. Of course, humanly speaking, you're tempted to give him a good rating. So there is a conflict of interest. And I think that this fundamental problem needs to be resolved. Now, let me just revert back to a previous question. Again, if I buy debt, if I buy a paper, my question is, are you able to pay me back? And if the income is not there, if the cash flow is not there, why should I buy your paper? So I think that we have been building a tower that has a foundation to sustain 5 stories, 5 floors. Right now, we are on the 10th floor in the penthouse, and we say, oh, what a great view. The structure, the tower is coming down. And we are admiring the view. Just get out. Just get out.
Okay, what about you, Ariam, who is in the risk management business?
Unfortunately, the rating agencies play a tremendous role, but we at Wells Fargo have been trying to limit as much as possible the influence, especially in terms of grading countries and managing risks.
How do you do that?
Across, our models are built basically without including many of these rating agency ratings. We comment on them, obviously we have to, because they play a fundamental part in driving market activity. But really, we really do not try to incorporate those ratings into our models. Because we just feel that, as John said, these guys are, many times they're late to the ballgame.
So you have internal systems?
Yeah, we do. Yeah, we do have internal risk rating systems that does not incorporate. I'm sure every bank does. You know, I wouldn't really. I'm not a big fan of the rating agencies by any means whatsoever.
I wanted to come back to the Greek banks because, as you know, they hold quite a lot of Greek debt and so on. However, as you know, they've moved most of it in the held-to-maturity portfolios and so on. I wanted your opinion on that. Why do you think, I mean, it's obvious they don't want to have the daily, price changes affect their bottom line or their equity capital and so on, and that's why they've done so. However, I wanted to ask you, do you think that that was the right move? Do you think that this insulates them from future events?
This issue of held-to-maturity accounting is something that applies to all banks and not just Greek banks. And I'm reminded of the fact that the stress tests didn't include this holding. And so, of course, many banks managed to pass these tests. So I suppose we could be quite cynical about that. But the reality of it is that it's an option that any bank should take. If it wants to hold an asset for its entire life, then why not? And actually, if you buy something at 60 that matures at par in 4 years' time, then you could realize 10 a year during that period. So for me, the issue is what level are these bonds actually in the accounts? And around the world, different banks have different ideas about what's conservative. And that will determine what the extent of potential recapitalization is in the event of a restructuring. But I don't know what the number is. I'm guessing some banks will be more conservative than others. but ultimately it will involve some need to transfer capital if there is a restructuring event.
What about the restructuring of the Greek banking sector? Whereas definitely bond holdings play a role along with loans, complementarity of branch networks and so on. What do you think? There is a lot of talk here about M&A activity in the banks. NBG is raising, 1.8 billion euro capital, fresh capital, and so on. What's your view on the Greek banking sector? Do you think that where do we head?
If we look at some standard measures of whether or not Greek banks have enough capital, I would say traditional measures show us that Greek banks have enough capital. However, I see three problems in the Greek banking sector. Problem number one is the issue of the assets. I questioned the values in the asset side of the balance sheet, whether or not they are true, the numbers that I'm reading, and whether or not they have taken into consideration risk-adjusted assets, the RWA.
Well,
So
they take it in calculating the capital
Yeah.
adequacy ratio.
Yeah.
That's by definition.
Yeah, but my concern is that if enough discount has been given to those papers they're holding. That's question number one. Second problem I see in the Greek banking sector is the declining profitability. If we look at the Greek commercial banks, their profitability in 2009 went down by 93%. That's huge. In the Greek banking groups, it went down by approximately 70%. That's also huge. So the declining profitability of the Greek banking sector, it's a major issue. And the third problem is the non-performing loans and the late loans. So those three problems need to be addressed before an M&A activity, not just between Greek banks. It has to be a foreign player who comes in, or separate foreign players who come in for an M&A activity. And for this to take place, the value of the Greek banks, let's say those who are publicly traded, needs to have an additional haircut of at least another 30%.
Well, let me ask you, Stephen. I know you're not in the investment banking of the HSBC, but you know very well the bonds and the bond market, and you know the Greek banks and so on. Would you be interested in, would you look at a Greek bank?
I think you know I'm not going to answer that question.
I tried. What about you? You're far away, you can, you know.
We have some very strong relationships with a number of Greek banks here, and I think that will continue. These are very profitable. Obviously, the profitability issue is a concern, but they're still profitable. Capital adequacy ratios have deteriorated and NPLs are rising, but our stance on the Greek banking system is probably the strongest of the three pillars that we focus on, which is banking, macroeconomy, and politics. This is one area that we feel somewhat more comforted by. But again, I think we'll continue to have relationships with the core and the principal bank players here. I don't know about acquiring a Greek bank. We just acquired Wachovia, so I think that's enough risk for a couple of years.
Okay. Liquidity. I think this is the biggest problem for Greek and other European banks at this point. Everybody's talking about the dependence of banks on the ECB and so on. What do you think, Stephen? How do you think things are going to evolve there?
Yeah, in fact, the repo situation is interesting because we don't know the exact amount, but it's considerable. So Greek banks are dependent on the ECB for liquidity. And an interesting comparison is perhaps with Spain. Spain had, I think, officially more than 100 billion nearly 120 with the ECB recently, but in August managed to reduce it by 20 in one shot because of the LCH, the London Clearing House, which offered an opportunity to refinance at half price, EONIA plus 4 to 5 basis points. Now that was an advantage that Spain managed to take and will continue to take, I guess, in the September numbers, because the domestic holdings of the bonds are high, a function of strong fundamentals in Spain, and this meant that the Spanish banks were able to adjust from ECB to LCH. Now, that option isn't as open to Greece as it is to Spain because of the rating, which came very late. And I think that this situation will have to just continue. So it's not something that the ECB can do much about, right? If the ECB wants to exit from this strategy, it's going to put greater pressure on Greece. So my view on all of this is that the ECB is part of the troika that's standing behind Greece, and if it wants to continue to do so, then the repo facility will just keep rolling into the future.
Do you have a view on this?
I think we need to go back to the root of the problem, which is over-collateralization and over-securitization. If we look at a graph of securitization in Europe or the US, we'll see that increase at an exponential, at a geometric growth rate between 2000 and 2007. And since then, securitization has collapsed. For example, in Europe, it was in 2007, roughly $3.5 trillion. Right now, it's only $500 billion. So the liquidity doesn't exist because securitization is frozen and it's declining. And it will not be revived simply because I think, thank God, finally we understood that we have a cancer in our midst. And we need to reduce this overextension of credit. By the way, where does the ECB find the money? They just have a printing press. Where do they find the money? They just have a printing press. Where does the Fed find the money? They just have a printing press. I think this is schizophrenic. We just keep printing money, and we think that through the printing machine, we're going to solve our problems. We can never solve our problems through the printing machine.
There's been no printing of money. There's been an expansion of balance sheet, which is different.
They're expanding the monetary base.
It's an egregious term to say printing. There's been no printing of money.
Yeah, but they're expanding the monetary base. It's exactly the same problem of the 1930s. The monetary base is increasing, and money supply is decreasing.
It's completely different. There is cash for an asset. The balance sheet is bigger, but there's no printing of money.
Yeah, but take the Fed, for example.
No printing of money. There's been no printing. You have to have an asset and liability. All that's happened is the balance sheet has expanded.
The balance sheet of the Fed is expanding.
Yeah, but no printing.
But the money supply is declining, which is exactly the same problem as the 1930s.
Yeah,
shall we ask our audience to pose, to take some questions? Is there anybody who would like to, because I see we are running out of time, I thought we'd have more time. It was, we could take some questions, if any. Yes, please.
Just a general question. Would you differentiate between short-term Greek debt, let's say under 2 years, and longer-term Greek debt? Because there's a school of thought that says that on the shorter term, provided Greece does continue with its restructuring program, etc., the short-term debt is actually reasonably safe. It's not in the same pot as the longer-term debt. Would you agree with this statement?
I have the opposite view. I think the safest bet is the very long end. So if you can buy something with a price close to 50, and if the disaster scenario, the worst case scenario, is that there is a restructuring involving a haircut of 50%, as long as the exit yield is below the current yield, close to 11, if you had an exit yield of 8 or 9%, you're going to make a lot of money, because you're going to get 30 coupons and half of your principal. If you buy a short-dated bond, you could get extended. The bond that you think currently is 2-year might actually become a 10-year.
Yep. Why would they do that if they have a restructuring program and you have IMF covering all your needs until 2013?
But I think you're mixing the liquidity and other issues. So, I mean, on the one hand, it's right to to perhaps think that because there's a refinancing scheme in place, there's not going to be a default. But I would question that. The precedent of other restructurings in emerging market countries, I hate to make that comparison, but that's where we are now. When we make the comparison with what's happened with Argentina and Russia and elsewhere, the involvement of the IMF does not exclude a restructuring at some point. And that's the fact, right? So owning a 1 to 2 year bond may look like it makes sense because the yield is high and there is refinancing in place, but I think that you're taking a huge amount of capital risk to pick up those few percent a year over other European bonds and risk half of your capital doesn't make sense to me. I would sooner buy something else.
Thank you.
We have, I think, some time for another question. Yes, please.
Right now there's, I don't know, they're trying to move the debt from the European banks to the ECB. The ECB has bought 40 billion directly Greek bonds. And they have lent Greek banks with 97 billions with a haircut of 123 billions of euros. So that means that in total Greece, let's say, has 40% relationship from ECB. So do you think that they're trying, to make ECB, right now ECB is, let's say, a toxic bank because it has so many toxic assets. It's like storing many toxic assets because of Moody's, because they have put this, these grades to Greek bonds. Do you think that this process is on purpose in order for Greece to carry on restructuring its debt with ECB? Or just, is there a global strategy transferring the debt from banks to organizations, to ECB, to IMF, to European Union? And then it's better to negotiate with them. Is this is this happening on purpose?
I'm happy to answer, but I'll let the other guys have a go. I'm happy to answer as well.
You want to answer it?
You want to take it? Or?
I think this is more up your alley, the fixed income.
Since you're the expert.
Well, I wouldn't claim that, but there's several parts to this, but very quickly, the 40-odd billion that the ECB has directly, it didn't buy at par. It bought in May, so actually it may even have a mark-to-market profit on it. Exactly. So whether that's toxic or not is another question. They could be sitting on a nice profit. They will hold them as long as they need to. And I think it is part of the process of removing the risk from the banking system into some centralized institution whereby these more systemic elements of risk can be managed, right? But anyway, the ECB is sitting probably on some profit here. The other piece you talked about was the repo, and I think it is close to 100 billion, but we've discussed this, and others say it's nearer to 80. But let's just say it's 80 to 100 billion in euro. That's indirect. The risk is with the banks. In the event of there being a haircut, it's the banks that have the capital risk. So that's where the recapitalization would have to take place. So the ECB doesn't have a major problem in terms of its exposure. Maybe it will do if it continues to buy, but it depends at what level it buys at. So I don't see it as being a major problem. I even see it as being part of the longer term strategy to work through this, in a kind of muddling through sense.
Do we have another question? Well, I don't see. Well, I want to thank you all very much for listening to us, and especially our panelists here, John, Ariam, and Stephen. Thank you very much again for your time.